Well, let's get started in the with the time that we have and the time we've allotted. We'll try to do our best to stick to that. It's going to be a bit more informal than it maybe was yesterday, but on Tuesday rather. But to go through the process, my name is Dave Burt. I'm the managing director of the for-profit side of the FAI house, also known as FAI Member Services. I also serve as president of Independent Market Solutions. As you may or may not know, Independent Market Solutions facilitates relationships between agents who are unable to secure company appointments due to any number of reasons, and carriers with an appetite for writing coverage. So if the two of you or those that listen later are interested in applying for any of the programs, including the one you're about to learn about today, you simply need to go to the IMS site at www.imsaccess.com. You hit the Apply Now button. You'll need to complete the information provided on the 5 tabs included in the application process. Our marketing team will then verify your membership, and then they forward that information to the carriers that you've selected. Your information is then reviewed by the carriers, and you're contacted regarding next steps. Again, if you need additional information on the IMS program or any of the FAI member services programs that we offer, please don't hesitate to reach out to me. My email address is dburt, B-U-R-T, @fai.com. And my direct line is 850-702-5653. Okay, today I'm happy to introduce our newest partner to the IMS platform, CNA Surety. CNA Surety provides a full range of surety and Fidelity Bonds in all 50 states, Canada, and Puerto Rico. They have the capacity, experience, and dedication to serve a full range of bonding needs, from the smallest commercial bonds to multi-million-dollar contract bonds. Joining us today from the CNA team are Brian Sittig and John Weiland, who are both underwriters with CNA, have both been underwriters with the CNA Surety team for over 30 years. Both have designations of associate in Fidelity and Surety bonding. They are based in Sioux Falls, South Dakota. Brian is the director of underwriting, and John is the director of channels underwriting. So with that, I'll turn it over to the professionals. Brian, you can go ahead and start the presentation.
Well, thank you, David. I don't know if I could say I'm a professional or not, but I'll let you guys make the call on that after this. So normally I would show my video, but I am multitasking here and trying to handle multiple things, and I don't ever want to let people see me sweat. So you're going to have this disembodied voice. But please jump in and don't be afraid to interrupt me if you ever have any questions during the presentation. So welcome to Surety Bonds Exchange. By the end of this session, we hope that you will be able to explain the basics of what a surety bond is and what the different types of general surety bonds are. At the very least, we hope to provide you with enough information where perhaps you don't break out into a cold sweat if you're just not familiar with what a surety bond is or does. And at the very least, we'll give you an 800 number that you can call to phone a friend. Should you ever have any questions, that's what we're here for. We want to make it easy for you, surety bonding easy, so you don't have to know all the answers there. I'm going to ask a quick favor of you, though. I want to try and learn something from you, and this is just for my own personal benefit, but I would like to know how agents like to hear from us. Because we're up there in windy Sioux Falls, South Dakota, and it's not always easy to get out in the field, obviously. So we have marketing reps that go around and do that. But when an underwriter calls, we want to make that visit impactful for you. So just in the chat, if you would say, how do you want underwriting to communicate to you? Do you want an in-person visit? Would you rather have a virtual visit via Zooms or Teams? Would you like to hear from us by email or text or phone? We're just curious because we want to do better at our job, and communication is key. And that's one thing that we found out through this pandemic is you cannot communicate enough, but you have to do it in a manner and in a way that your clients want to hear from you to be effective. So thank you for that. And now we will jump into surety bonds explained. So here is the definition of a surety bond. As you can see, a surety bond is a written agreement providing for monetary compensation should there be a failure to perform specified acts within a stated period. It's a three-party contract. Simple. That's all you need, right? I wish I could say that. Just to give you an example, I recently taught ethics for junior achievement to sophomore class a couple of weeks ago, and I think John did it as well. I have to tell you, if you've ever talked to sophomores, it's terrifying, but it is a rewarding experience. So I wanted to point that out. But what I tried to boil down what a surety bond does for them, I couldn't read this definition, but basically, a surety company ensures that someone will keep their promise to do what they say they're going to do. And if they don't, we will keep that promise for them, either compensating the harmed party through monetary funds or by actually doing the work itself. So that's surety bond in a nutshell. Now, to kind of show this in a visual representation, here is basically what a surety bond is. There's a principal, which is different from insurance. Insurance, you talk about an insured, but in surety, it's a principal. They are the party to required to obtain the bond, okay? And then there's the obligee. It's usually that third party who says to somebody, I'm going to hire you to do something, or I'm signing a contract, or I'm asking you to do something, but I want to guarantee you're going to do what you say you're going to do. So that's where the third party comes in. And then there is the surety. The surety steps in and provides that guarantee to the obligee that the principal will say what they're going to do. Okay. Now it's kind of interesting. The arrows go round and round, but I would point out, if you reverse those arrows, it's the same type of arrangement. And we have the same guarantees to everybody. So it really kind of gives it. There's a principal that works with the surety to work with an obligee. The obligee requires it of the principal, and vice versa. So we're all intertwined here together. Now, the easiest way to define surety to an insurance agent is to define, or basically compared to, insurance. So a lot of times we get compared to insurance because we work through insurance agents, but surety is a three-party agreement, and I showed that to you: the principal, the obligee, and the surety. Insurance is a two-party agreement. You have the insured generally, and you have the insuring company. Okay, when I'm going to say general, because what you find with insurance, there's always exceptions, but with surety, there are always exceptions multiplied. So just to boil it down there. Now, with surety, losses are not expected. As an underwriter, my goal is to write a bond never to have a loss. Okay, I'm imperfect, so I can guarantee and tell you that has happened. I have written bonds with losses, but we don't expect a loss when we write a bond, whereas losses are expected with insurance. I don't have to tell you that. If you charge enough premium, you could probably write insurance for about everything. But, I'm just exaggerating here to show you that. But surety bond, losses are not expected. With surety, losses are recoverable. So if we pay a claim on a surety bond, we certainly expect to get reimbursed by the principal for that surety claim. Whereas you all know with insurance, insurance is purchased to protect the insured. So if a loss is paid out under an insurance policy, the insured is not expected to pay the insurance company back. Premiums with a surety bond are meant to cover expenses and not necessarily losses. Now, there's always, we try and rate surety bonds based on the amount of underwriting we do. So the more underwriting we have to do, generally the more expensive the premium. But the premiums for surety bonds are to cover an expense. Think of it more like the underwriting fees when you get a mortgage. That's what a surety premium does. With insurance, premiums cover losses and expenses. So you are calculating potential future losses and also trying to recoup those underwriting expenses within that. So that's another difference there. Sureties are selective. There are just some risks that a surety will not write. Okay, that is the ultimate job of a surety. Now, I won't kid you. There are sureties that are very aggressive. So it depends on the underwriting appetite of a surety company. Some may be more conservative and not write selected risks. Others may be more aggressive or maybe new to the market. So they may be willing to write more risks and look more aggressive, but it's only because they're doing it for another reason. And there are risks that we should say no to, and we do say no to. Insurers write most risks. If they can charge enough money, they will write it, or if they can add in enough conditions, they will write it. So those are the differences between surety and insurance. So do you have any questions related to that? If you do, just let me know. You can put them in the chat as well. Now, okay, a little difference between a surety bond and an insurance policy. Most of the time you can go to an insurance policy and look to see what the conditions are. Everything is laid out in the policy, okay? With the surety bond, it is not always the case, because a lot of times the bond itself, it just has basic information and it refers to an outside either statute or contract or something. So to find out what a surety bond guarantees, you really also have to look at that underlying agreement or statute or ordinance that it is agreeing to. But there are some general things that you will see in a surety bond, and I'm going to point those out now. There's an insuring clause. It's similar to the insurance policy. Okay. No, all men buy these presents. That's similar to what an insurance policy says. A surety bond generally has the reason for the bond. It tells why the bond is required and what it guarantees. In other words, it's the conditions of the bond. There is the surety guarantee in most bonds. And this paragraph, like it says, if the principal doesn't pay or perform the duties as prescribed by the law, here's where a license and permit, you have to go look to the statute or ordinance to determine what that principal has to do to follow the law. And if they don't do that, the surety will pay. And then there is other provisions. Okay, other provisions. This explains how claims must be reported, how the bond can be terminated, the cancellation clause within it, and the terms of the particular bond agreement. Okay, so just a couple of things in there. You might not always know how to report a claim in a surety bond. Well, if a state requires that, then there should be additional notices attached to the bond to provide the principal and you, the agent, that information. But not all surety bonds can be canceled, and I'll talk about that later on. There are additional conditions that can be put in a bond form in addition to the underlying agreement that could make it more difficult to underwrite. there could be no cancellation. So once we're on a bond, we're on it. We can't get off the risk. Or the bond could be forfeiture. The main purpose of a surety bond is to reimburse for the actual loss. But sometimes obligees want the bond and want it to be used as a punishment as well. So they say, well, I'm going to require you to get a $20,000 bond. But if I suffer a $5,000 loss, I'm not just going to collect the $5,000. You're going to forfeit the entire $20,000 amount. So it's meant more like a forfeiture. Cumulative liability. What that does is it starts stacking the obligation of the surety for each renewal that is written for that bond. So instead of a face value $10,000 bond, if that bond renews 5 times, the surety has liability a total of $50,000, one for each of those annual terms written there. You can also see bonds per claim or per permit. That's blanket type. But there's just many provisions. So while you can't read a bond form to get all of those provisions, that's why sureties like to use their own bond forms, because they control them. And if an obligee has theirs, we always have to look at it. Okay. Now, not all risks use the same application, just like insurance. I'm not telling you anything new here. What we at CNA Surety have done has tried to make it easier for our agents. Instead of having 10 different applications for 10 different bonds, at least for the initial review, we tried to gather all the information we would need to underwrite multiple bonds on one application. And you may be familiar with it. It's our Form 10 application for any kind. Okay. And then also we recognize some bonds are written very easily with minimal information, name and address. Basically, that's what we need based on the risk itself and the claim history. We don't have to or need a lot of underwriting information. Other ones need additional information. So when you see an application like this and you see a financial statement on there, that doesn't always mean a financial statement is going to be required. If you look at our Form 10 application on the back, we kind of list out the different types of bond that John will be talking about later. And it tells you for this type, we need a financial statement. For this one, no, you don't need to do it. So don't get confused and assume, oh, I have to complete all this. Look at the type of bond, look on the back of it, or read the materials on our website, and then we can tell you. Our goal is to simplify the process for you. Okay. A lot of times what we're doing is trying to get enough information to underwrite most of the type of bonds we do, at least initially. There are a lot of bonds that have been moving to a credit-based model, and you'll see that. So that's why a lot of times we ask for social security number and residential address and full name. It doesn't mean that it's required for every bond, but generally, if you need a license and permit type bond and it's not at the local level, that's what you have to provide. So that's why we ask it. Now there's this section here, indemnity. Okay, you hear that word a lot in surety. So what is it? To be honest, I'll just talk in biz law. I was in college years ago. I won't tell you when I graduated to date myself, but I sat through biz law and biz law 1 and biz law 2, and we talked about indemnity. And I go, what is this indemnity and why am I going to need it? I didn't think I would ever need it at all. And then I go to work for surety for 34 years, and it's basically, I deal with indemnity every day. So you never know. Most surety applications do include an indemnity agreement for the risk where we want a personal guarantee from the owner that they will reimburse us for costs and expenses. or they personally guarantee on behalf of their business. Okay. Another term that I learned in biz law is common law. And with common law, a surety is granted the ability to recoup themselves for the payment of the actual loss itself. They don't have to have a signed application or anything. If they pay a surety loss, they can recoup that under common law. That's just granted. However, by providing us with indemnity on an application, the people that provide their indemnity are also saying they will recoup us for any additional expenses that we incur outside of the payment of that claim. So that could be underwriting expenses, that could be claim handling expenses, that guarantees the payment of a premium itself. So there's where a lot of times we ask for indemnity because of the underwriting involved and the chances of the claim increasing. We want that guarantee to reimburse us in the event there are additional expenses. Now, how often do we get reimbursed for indemnity? I can't say it's successful in every case, and I can't say it's successful in most of the cases. But I tell you what, it does help us to alleviate or settle some claims before we even pay them, because we can hold it up and tell the party, hey, you need to do this. And if you don't, do you realize if we pay, we're going to come after you and get reimbursement. So either do what you say you're going to do. You're either going to have to do that, or you're going to have to pay us. Okay. Now, a lot of times we spend a lot of times just the agent and the surety company trying to get proper indemnity. Because if you're like me and didn't listen into your business law class and you're an applicant, you probably don't understand what you're doing by signing it. And that's where our job comes in. You need to read the indemnity agreement, but I just want to explain what this does. So we ask for, if it's a corporation, you have to get different types of indemnity based on the different business type. So for a corporation, we want to get the corporation to guarantee those additional expenses. So by the president signing, he is saying obligating the corporation. And then if it is a small 1 or 2 person owned company, then we go and ask the owners to personally indemnify. This is especially true if we're basing our underwriting on personal credit reports. A lot of times we're not even getting any information on the corporation. So just getting the corporate indemnity, that really doesn't provide us with any guarantee, because we're not correlating that to what the underwriting we did. If it's a publicly traded company, yes, then all we need is corporate indemnity, because you're not going to get the stockholders to personally indemnify. So that's why it's important that we know, okay, a corporation, what type of corporation in it? The small commercial operation in Sioux Falls, we deal with a lot of small businesses. While we do write bonds for public corporations, it's generally the smaller 1 or 2 person owned businesses. So that's why we assume, and that's why we're getting this personal indemnity. So you see there, John Doe, he, if the business isn't strong enough, a lot of times, if it's a small corporation, they look at it as one and the same. My personal assets with the corporation. Well, that's why we get both, because they are sharing those assets, or basically it's one and the same. And then the same reason you see Jane Doe there, or Ann Doe, the spouses. Okay, a lot of times we get asked, why does my spouse have to sign when they don't have anything to do with the business? Well, if we're basing our underwriting based on the personal assets of the owners of the company, in most cases, the owners own those assets jointly with their spouses. And we've been in this business so long, we see where sometimes if we didn't get spousal indemnity, the owner just transfers the assets to the spouse. So that's why we just try and get it all up front. And we don't have to worry about then, okay, who owns the personal assets, or is there agreement in place and all that. We're just trying to make it easier for you, the agent, to do that all up front instead of trying to get that. And by doing that, we can reduce the amount of underwriting information we need. So it may seem like a lot of work, but we're actually, by doing this, it just cuts off a lot of the underwriting information that you would need to get in depth there. So I've shown you indemnity for a corporation, but if you think about it, there's a limited liability company. You know, and when limited liability companies were set up, the managing member, they didn't have president. You couldn't be a president because it was confused too much with the corporation. But varying states have different rules. So we have to know how to sign for a limited liability company. A partnership. You have general partnerships and you have limited partnerships. It may change the way we require indemnity, but not most of the cases that we write. If we are provided with this basic type of indemnity, we're fine. And then just to really complicate things with indemnity, you can even get the indemnity of an estate of a deceased person. So, and we see that. We see bond requests in the name of the estate of a deceased person. So what we need to do there, instead of getting personal indemnity of an owner, we get the estate's indemnity, but then we also get the indemnity of a couple of heirs who are going to benefit from that estate. So I've gone through that rather quickly, and I apologize, but bond renewals. Okay, I just want to explain bond renewals there. Surety bonds are generally written for a specific risk for a specific term spelled out in the agreement. A lot of them do not renew, but a lot of them do. And commercial surety bonds that we write in Sioux Falls generally are billed on an annual basis and they renew. Now, just because they're billed on an annual basis, that doesn't necessarily equate to say they're an annual risk. So it's a little bit of a difference, but I just want to kind of try and explain that here. Some commercial surety bonds renew with the statement, and that is where the original bond form doesn't have an expiration date in it. The bond is continuous until canceled, and as long as the principal continues to pay the renewal premium, the bond is in place, and no renewal documentation is needed. Okay. Some bonds have an expiration date in them. We call them term bonds. And that is when there is a definite expiration date in the coverage and it needs to be renewed with the continuation certificate. The difference between a continuation certificate and a renewal bond, which I'll talk about next, is a continuation certificate only extends the original bond obligation. And the certificate to be valid and to renew the bond must be filed with the original bond. So basically it just says that $10,000 bond there, it's just that is extended for this term, but it doesn't aggregate the exposure of the liability. And who requires it? It just depends on what the obligee wants. And then there are the bonds that have renewal. That's the same thing. It's a term bond that has an expiration date in it, and the new bond must be renewed and filed with the obligee. Okay, it doesn't necessarily have to be filed with the original bond because it's a brand new bond, but it has the same number and everything. So if you look at it, the obligees may say, no, I want $10,000 in coverage for this term. I want $10,000 for this one, and they want a renewal bond. So that's why there's a difference between how you renew them. It's what the obligee requires. A lot of time with statements or bonds that are continuous, you see those are non-cancelable. A lot of times that's probate court. Okay. or you can even consider a contract bond, but contract bonds don't renew. So that's for a specific term, but a probate bond, it's required by the court for as long as it takes to either have a guardian of that ward as long as it's needed, or for however long it takes for that estate to be closed, which could be multiple years. We bill it annually, but the bond is continuous. Now, cancellation of bonds. I've talked about that a lot. Sureties prefer to write bonds that we can cancel. Okay. And part of the reason of that is conditions can change. You can't guarantee that a principal that you underwrite, 3 years ago when you originally wrote the bond, that they haven't decreased financially or had problems. So surety companies want the ability to get off a bond if underwriting conditions have changed, but that isn't always the case. So what a surety company has to do is look at the risk and look at their appetite and say, can I write this bond without a cancellation clause? And we write a lot of bonds without cancellation clauses, but we have to take that into consideration with our underwriting. So it's dependent on the bond terms. Bonds can have a termination date, they can have a cancellation provision, or like probate and public official, we have to keep it open until the obligee says we are not obligated on that bond anymore. So a lot of times I talk about indemnity. That's why surety wants the indemnity up front. If once certain types of bonds are filed with the court, we're stuck on it. We're obligated on it, no matter if we don't get paid a premium or the principal lied to us and said, you know what, I'm not going to do anything I said. So we have to have those guarantees that will all relate back to indemnity and all that. So I've gone over that quickly. If you have any questions, you can put them into the chat. I'll try and answer them. If not, John and I will give you our contact information at the end. You can always send them in and we'll answer them by email, but I'm going to hand it off to John right now, and he's going to talk about the different types of bonds. So John, take it away.
Yeah, thank you. And Brian just covered basically the building blocks of surety. And I would just like to take a little bit of a pause, and if anybody's comfortable, I know Joe and Rod, I certainly see you as participants in the meeting. Can you tell us in just a few, do you have some surety requests? Do you have some current appointments with surety carriers? And I think if I knew that, I can kind of tailor the next, 20 minutes or so a little better. We certainly with this size of group, we'd love this to be a little more conversational. So if either of you is willing to, speak at all, we'd love to hear what's your background and what do you specifically want to know more about when it comes to surety?
Now, I know Rod never is there a time where he is not interested in, chiming in. So he may have gotten hung up.
Okay.
We may just need to rock on here.
Okay, absolutely, no problem. And we will go fairly quickly so we can leave some time open for questions. But, as Brian said, I'm going to break down the 8 different, specific bond families. And the first family we're going to talk about are license and permit bonds. Probably one of the most common requirements you'll see in Florida. They guarantee the licensee will operate according to the law that the city, county, state has established. The specific bond, as Brian mentioned, is codified. So while the bond may not list the specific guarantees, it will typically point to a statute or ordinance. And as I think Brian touched on as well, the obligee, which in this case is the city, county, state, transfers the qualification process to the surety company. So basically, we're pre-qualifying. If we pick the wrong licensee, it's likely a claim will result. The bond may protect the government body directly, but coverage may also extend to third parties damaged by the principal's breach. Large markets of these bonds exist in Florida. $31 million is what we figure the license and permit market is. Getting a little more specific, I'll talk, to the different bond requirements. You may have been approached to write a contractor license type bond. I know there's Hillsborough County is a huge requirer of license and permit bonds. You may see car dealers, pawnbrokers, collection agencies, mortgage brokers, or title agents also required to file a license and permit bond before they can obtain their license and begin operating. There are some basic types of license and permit bonds that we basically bucket, and we start on this slide with the least hazardous to the most hazardous. So regulatory, they simply put limits on businesses and guarantee they will operate according to the law. Normally small, local, and underwritten freely. Electrical contractor bond required by a city would be an example of a regulatory bond. Simply guarantee the electrician performs his work according to code. Public safety is the next level, and that protects the general public against physical damage. Types of professions that could inflict a financial loss because of physical damage. For these, think about demolition contractors, house movers, possibly sign hangers. A little bit more risk in issuing bonds for this type of occupation. Next, we go to public protection, and that protects the public against loss due to financial damage rather than physical damage. The surety will use a credit scoring tool, as Brian touched on, and ask about experience, reputation to consider public protection bonds. Examples of these would be motor vehicle dealers, employment agencies, collection agencies. Finally, the most hazardous license and permit type are financial guarantee or financial obligation bond. They guarantee the payment of money if the principal fails to pay taxes or charges. They're tough to underwrite. Basically, as a surety, we're guaranteeing the business will continue to survive so they can pay their bills. Examples of these are liquor tax, gas tax, sales tax required, sales tax type bonds. Typically, to make this seminar valuable, we absolutely want to give you some practical ways on how to develop this business. So, you can get involved with local city or commission meetings to see who's opening businesses, watch for new construction and make your approach there. Regular visits to the city clerk's office and making the city clerk aware that you are a surety bond outlet is important. Running ads, absolutely working the internet, having your website, show that you are a source for surety. And then you can work with commercial real estate firms also to gain referrals. I'm going to move next to Fidelity Bonds, often referred to as honesty insurance. Using insurance terms, the obligee in this case is the insured and the coverage is the insurance. Generally protects an employer from loss due to a dishonest act by a bonded employee. Varying coverage amounts are available. Coverage needed is determined by the access the employee has to goods or money at one time. Purchase of this bond is absolutely by choice of the applicant and not required generally, though we will see cases come to us where perhaps a cleaning company is required by a financial institution to show proof of Fidelity Bond coverage before they're allowed access to the property. We have certain coverages that we write under the Fidelity, and those are dishonesty Form A, Form B, and janitorial service. Form A covers the employer's property only from a dishonest employee. It's designed for those businesses with less exposure. Think about accountants, doctors, dentists, and attorneys. Nonprofit coverage is available to officers only. So if you insure and cover lots of nonprofits, we have a bond that can protect the association from a dishonest officer. Volunteers in that situation are typically excluded. There's also, excuse me one second, there's also the dishonesty form B. Now that's designated for businesses with a little bit higher exposure. Think about gas stations, restaurants, retail operations. That form contains a conviction clause, meaning that the defaulting employee must be criminally convicted for coverage to apply. That coverage also can contain what's known as subscriber liability, meaning that those who subscribe to that business's service may have coverage. Now, subscriber liability is not third-party liability, as the claimant must still make a claim through the employer, not directly to the surety. And then finally, we wanted to talk about janitorial services. This is a specialty product that is very popular in Florida, designed to protect the subscribers or customers of a cleaning business against a dishonest act by one of their employees. The janitorial service bond contains that conviction clause, and it includes only subscriber liability, meaning protection is extended to those businesses that the cleaning company cleans. The employer's property, say their broom or their cleaning supplies, are not covered, and there is $100 deductible to this Fidelity coverage. How do you develop this business? You can send brochures or emails with renewal notices to your commercial clients, absolutely advertising online that you can provide this coverage, leveraging your business association meetings, and review all current commercial client files and provide them if they have this sort of gap. Next, I want to move, and I'm moving fairly quickly, but don't hesitate to ask questions, to the fiduciary bonds. A fiduciary handles the affairs of another or takes control of someone else's property. They are also known as probate bonds. Administrators, guardians, and guardian of minor are all examples. A fiduciary bond guarantees an honest accounting of all assets, faithful performance of duties required by law. Jurisdictions vary on if a fiduciary is required to be bonded. It's important to advocate for the importance of bonding to protect vulnerable assets of the deceased or the incapacitated, those who can't care for their own assets. You can see the premium nationwide and the market size in Florida. I'm going to break down a little deeper into the administrator, executor, and personal rep bonds. They're required, of course, after somebody has passed away. If there's no will, the court may appoint an administrator or PR. If there is a will naming a person, the fiduciary will generally be called an executor. So, along with honesty, faithful performance, the fiduciary has the duty to follow all laws, probate regulations, and court orders. Ignorance does not absolve a fiduciary from compensating the estate if they violate their duties. And this is one reason that we and other sureties will almost always require that someone applying for this type of bond obtains the services of an attorney. As Brian mentioned, fiduciaries must be relieved of their duties by the court. This is not a cancelable bond, so we do need a release that entered with the court that discharges the bond. Next, I'll cover guardian or conservative incompetent bonds. They're required when someone is still living but needs the help of someone to help take care of themselves and their property. So, rather than gathering those assets to distribute to others, which is the case of an administrator executor type role, the guardian conservative preserves the assets for the ward's benefit. It's their job to be very conservative with those assets, hopefully making sure the assets outlive the ward. must pay nursing home, medical bills, and any other obligations in a timely manner. And similar to administrator bonds, the court will require accountings on a regular basis as evidence that the guardian is properly handling their duties. If they don't, we get the phone call. Next, I'm going to touch on guardian conservator of minor bonds. Very similar to conservator and guardian of incompetence, but these are for a minor who no longer has someone to care for them. These bonds are typically needed until that minor reaches the age of majority, 18, 19, or 21, depending on the state. And the role and the goal and the obligation here is for the conservator to preserve the funds until the child reaches age of majority. This can actually be one of the most hazardous type of fiduciary bonds. Oftentimes there's lots of disagreement between the guardian and the court on what is an acceptable use of those funds. Moving along to how do we develop this sort of business, build those relationships with your local attorneys. Let them know that you're an outlet for this type of bond. Solicit business from attorneys who are your existing clients, and just let your personal lines customers know when you interact with them that you are a fiduciary outlet for them. Next, I'm going to move to civil court bonds. I'm moving quickly, but we've got a little bit yet to cover. General terms, these are the bonds required by the court in a civil lawsuit. Typically, you've got plaintiff and defendant type court bonds. Plaintiff bonds are much easier to write than defendant court bonds. Generally, we require collateral if we're going to handle bonds on behalf of the defendant, just because of the way that most court cases go. Market size, you can see, is substantial, both nationally and in Florida. This next slide is simply, you will hear terms tossed about: attachment, replevin, indemnity to sheriff. Those are absolutely plaintiff bonds. You may hear appeal, counter attachment, counter replevin. Those are defendant type bonds. So we don't expect you to know a ton about those, but once you do come across that need, we absolutely want to intervene and support you throughout that application, issuance, and cancellation release process. Court bonds, again, let your attorney clients know that you're available as a provider of this. Is it worth your time to review court schedules? I think getting the local reputation that you are a provider of court bonds is really the way to go. I know Brian touched on public official bonds, and that's similar to bonding employees for Fidelity Bonds. But actually, this bond guarantees that the public official will fulfill their duties honestly and faithfully according to the law. Now, you may have noticed, instead of just honesty insurance, we include something in this sort of bond known as faithful performance. And that means that an innocent act could be covered if the action causing the loss was not prudent or reasonable. The example I typically give there is if a city treasurer ignores a bank's failing status and deposits the city general fund into that bank. Even though they did nothing dishonest, they did not faithfully perform their job if that bank were to later fail and city funds were lost. So any level of government can be required to get a bond. There are two distinct differences: those that have access to funds, the public funds, and those that are more administrative. When I talk about administrative folks, think about auditors, peace officers, and those are typically easier written, easier to get. There are different forms, individual, schedule, blanket. The government entity will absolutely direct you in what they would need there. How do we develop this business? Again, attend meetings of local governments, let them know you are an access. Florida is a huge notary bond state. Absolutely, the bond here guarantees that the notary will faithfully and honestly perform the duties of their role. Those bonds do protect the public, not the notary. So if somebody notarizes something without following proper procedures or obtaining proper identification, the public is protected. Please understand the notary is not. And that is why CNA Surety sells an accompanying product called Notary Errors and Omissions Coverage. And this basically protects the notary in the event they make an unintentional mistake. This can be used to, it's a low premium, it's a low cost, and it covers legal expenses. There is no deductible, and it can be used to cover the deductible of another policy. How can we, solicit this business? You can obtain a list of notaries, but typically, again, once you let them know you were a bond provider, this sort of business just kind of comes through the door. I'm going to move to miscellaneous bonds. We're moving quickly. Many types of protection here: honesty, compliance, financial guarantee. These are basically all different agreements. You might hear Airline Reporting Corporation, Lost Instrument, Indemnity to Union are some examples. I don't think I'll spend a lot of time on this. I'm going to move to the ways to develop business. Make sure your services are known to financial institutions locally. You can advertise, you can target associations whose members are travel agencies or who require miscellaneous bonds. Next, I'm going to move on to federal bonds. They are required by the federal government. Basically, they're a license and permit bond required federally. They may guarantee various fees and compliance with federal requirements. Think contract postal station, think customs bond, think durable medical equipment provider bonds. We see a significant demand for federal bonds, especially in Florida. Durable medical seems to really resonate in Florida. Next, I want to move on to contract bonds. They guarantee, as Brian touched on, fulfillment and performance of obligations relating to a written contract. These can be public or private. You may hear tossed about bid bond, performance bond, payment bond, maintenance bond, supply bond. CNA Surety is an active writer of all of these bonds. As you get into this, you will find this is a highly active, highly important market. Target contractors, tradesmen, or artisans that you insure. Absolutely, you can cross market to those license and permit bond clients, and you can look to local trade associations. Significant market size, and I'll apologize now, but we'll just go to, does anybody have any questions? I want to turn this over and just let you know, here's our website. Here's our general email address. Brian and I can give you our personal if you need it, and our 800 number.
I realize the slide doesn't have our email or the 800 number, so I'm going to give that right now, and I'll also put it in the chat. If you have any questions whatsoever, you can call 1-800-331-6053. We have 30 plus staff answering the phones from 6:30 a.m. Central Time to 6 p.m. Central Time, and you will get a live person on the phone to answer any questions you have. And if they can't answer them, then they direct them to underwriting.
Well, thank you guys. Great detail, great information. We look forward to this partnership. We look forward to sharing the partnership with our members. We will, again, this has been recorded, so we will make sure that our members have access to the link to be able to go in and listen to it at a later date. But we will certainly be in touch. We appreciate the partnership and look forward to adding some members to the program. And we know how to get a hold of you if we have questions or concerns.
Please do. We want to hear from you.
Thank you very much for the opportunity.
Thank you.
You bet. Thank you, guys.